General Mills' revenue and profitability is starting to slow down. However, they have a 4.15% dividend yield and plenty of room to grow that dividend over time. At its most cheap price ever, is General Mills a buy today? That's what we're talking about in this video. We'll be talking about who this company is, what has their past trend been in revenue and net income, and then what does their future look like for being able to pay out dividends. So let's just get into the overall analysis. We want to determine if this company is undervalued and set for high growth in order to minimize risk and maximize reward. So some quick info, the company is General Mills, their stock ticker is GIS, they're priced at $47 per share. They're way down from almost priced at $70 earlier this year. In addition, they have a P/E ratio of 12.2, which is ridiculously low. And then they were established in 1856. These guys have been around for a long while. And like I said, they have a dividend yield of 4.15%. So if they can grow that over time, now would be a great entry position. So that's one key area we have to analyze throughout this video. And then they are a dividend champion. They have been raising their dividend for well more than 25 years. Now, two quick disclaimers. First of all, this is by no means investment advice. This is for only educational purposes. Therefore, do your own research before ever considering investing in this stock. In addition, another disclaimer is that this information is incredibly valuable. And if you're new to the channel, make sure to hit the subscribe button or at least leave a like or a comment. So let's get into the checklist. Should we even be considering investing in this company? So they have a great starting yield. Their market cap is right in that, that very large area that's our general requirement of $7 billion to $400 billion. Their P ratio is incredibly low, which is really interesting and what really caught my eye about this company. Their 5-year average dividend growth rate is very nice. Their 5-year average payout ratio is a little bit high, but it's still pretty good. Plenty of years of raising dividends. We understand the business and it cannot be disrupted by Amazon. Let's talk about some important dates if you're considering investing in this company. So today is Saturday, August 18th. The next ex-dividend date is October 6th, which is 49 days away. They'll be telling us what that dividend will be in 39 days, and then you'll actually be receiving that dividend in 75 days. So I input a bunch of information like normal, and we're going to analyze it right now. So let's talk about their business model in case you don't know about how they generate revenue and net income. Basically, these guys sell a ton of different consumer goods. Best products are snacks, cereals, yogurts are the ones that do the best right now, but they're very diversified across all those segments within the consumer goods area. Their revenue for the past 5 years has been decreasing about 1% per year. However, on average, they're doing about $15.7 billion in revenue, so half their market cap. Some important notes on growth is that they have a trend of decreasing revenue. Organic growth is at 0, but profitability has been growing. That's a very interesting scenario, and there's a really cool chart I'll be bringing up later to explain that. One unique competitive advantage is their brands. I mean, you'll see with most dividend blue chips, their brands is huge. Brands is huge to overall success now and in the future. Then interestingly, they just had a unique acquisition of, I think, like Blue Pet products, something along those lines for $8 billion. So they're trying to go beyond just human consumer goods and go to pet consumer goods. An interesting move. However, there's a lot of questions about whether or not that'll actually provide a significant ROI or be a great means for overall growth. Next, I want to talk about risks. First of all, they have plateauing revenue. Organic growth is basically 0. However, they are becoming more profitable. And one interesting thing to always be aware of is this health trend going on in America, and basically mostly in America, I would say. This greater focus on eating the right foods, and not many of General Mills products necessarily directly fit with that and really support that trend overall. Next, I want to talk about their financial situation. We go to the balance sheet for that to really understand what does these companies' asset situation look like? Can they make some great investments? Can they make some key acquisitions like with the pet company? And then in addition, we want to make sure they don't have too much debt or overall liabilities, because that just really can disrupt their dividend and overall growth. So some notes on the balance sheet. They have 4.1 billion current assets to 7.3 current liabilities. This is one of the worst current ratios I've seen. Normally it's about 1-to-1, but they almost have half as many current assets to current liabilities. It's not the end of the world, but I don't like that ratio a ton right now. Total assets, total liabilities, that's a little bit more healthy. I like to see something around 200%, but 130 isn't the end of the world either. And then with long-term debt, you can see that's been it was plateauing a little bit, and then it's really picked up recently. So let's talk about their past 5-year return. And so another big reason this stock really caught my eye is because it's plummeted over the past year. So the past 5-year return has been negative 6%. And then with regards to the past 5-year return, that's about 1.3% decrease each year. For the past year return, they're down 17%. Like I said, they're trading at somewhere around $65, $70 past year, and since then it's just been brutal. Their PE ratio is incredibly low right now. That's very interesting. Price to book is a little high because they have a lot of debt. Price to sales is nice and low, and their debt to equity ratio is unfortunately quite high. Overall, let's take a look at some very important trends comparing the 10-year averages to the 5-year averages. So with regards to revenue, it's been decreasing at 1% per year for the past 5 years. However, with regards to the 10%, in regards to the 10-year averages, it's actually been increasing about 1.5%. So that's actually a huge X. I apologize. Don't get excited about that. Net income has been growing actually quite nicely over the past 5 years, and then dividends paid out growing very nicely. And then payout ratio is okay. It's a little high right now. For their 10-year average, that was great, 54%. But to have a 5-year average of 64%, that's much higher. And it's definitely an increasing trend I'm a little concerned about. But their dividend growth rate has been solid for the past 5 years, and that's what really excites me about this company. Great dividend growth rate, very nice and cheap at that 12 PE ratio right now. Their 5 to 10 ratio isn't the best, which, like I said, is dividing that 5-year dividend growth rate by the 10-year dividend growth rate to see if that growth rate is slowing down. And this suggests it is slowing down. But the current yield is really nice and high at 4.1%, 4.15%. So if we go over to my Nifty calculator right here, we see that based on the 5-year averages, this company has only 20 years left in paying out dividends. Now, they're going to be paying out dividends for much longer than that, which means that they're either going to have to really find a way to generate more sales and more income, or they're going to have to slow down their dividend growth rate, which is detrimental to dividend growth investing. So basically what this tells me right now is that if they can turn around and start generating a lot more revenue and net income, which is difficult, if they can do that, that would be one of the best entry points ever if you got into the stock today. But we're going to be really looking into can they turn that around in the near future in the rest of this video. So let's talk about some of these 10-year trends that we see. So like I said, the PE ratio is ridiculously low. It's at almost historical lows for the past 10 years. You can see that in 2009 it was pretty cheap, and then currently has a PE of 12.2. Its average PE has been 18.3, so the current PE is 2/3 of what it normally trades at. So that alone, if you were considering it to be a value investment and you're trying to get in now, that'd be an interesting entry point. Price to EBITDA, it is undervalued in that sense as well. And then if we go to the price to sales ratio, it's a little bit undervalued. And remember, in case you're new to these graphs and reading them, basically you want the stock price to be this thin blue line is the stock price. You want it to be trading below this yellow line, which is the average, where the stock should be trading at based on its averages. So for example, for the price to sales ratio, on average it trades at 1.9. On average, if the stock were to trade at its regular price to sales ratio, it should be at that yellow line. So when it's under that yellow line, that means it's undervalued. It should go up to its regular value. And when it's above that value, that means it's overvalued and needs to return to its value. And the blue line is the industry average. Okay, great. So then price to book ratio. Surprisingly, it's undervalued. On average, they've traded with a higher price to book ratio. However, I like to see, it's not a really big deal looking at the price to book ratio. Okay, great. Let's look at their trends in revenue and net income. Revenue, like I said, it was increasing from 2009 to 2013, 2014, Recently, it's been declining, and we need to look into can they turn around this situation. However, net income has been growing actually quite nicely. Operating cash flow has been growing decently, and then the payout ratios have been increasing, which is not good to see. For their price to yield, normally you've only been able to enter this stock and get a 3% yield. Now you're getting a 4% yield, which is a third higher than ever before. And then in addition, if we look to the earnings per share and then the dividends per share, we can see some nice earnings per share growth. And that's all looking not too bad. So let's look at their 5-year trends right now. So I love 5-year trends because this really tells me the most recent and updated information we need in order to make an educated decision with investing in the stock. So like I said, historically low PE, and based on the past 5 years, for the 10 years it's trading at around an 18 PE. For the past 5 years it's been trading at a 21 PE, and now it's trading at a 12 PE. I mean, that is ridiculously undervalued in that sense. However, that just doesn't mean we should jump into the stock, because a low PE can definitely indicate huge signs of investors losing confidence in the stock. Price to EBITDA, they are trading below that colorful line, which suggests they're undervalued in that sense. Price to sales a little bit undervalued, price to book a little bit undervalued. Love to see that combination. But unfortunately, this green line is revenue. That has been decreasing. Net income has been increasing. Operating cash flow has been increasing a little bit, which I do like to see. And payout ratios have been increasing. Okay, and then with regards to the price to yield, still, you've only been really able to get the stock at a 3% yield. You're now getting it at a 4% yield, which is much, much more nice. And then if we look at the dividends per share compared to the earnings per share, green line compared to yellow line, the earnings per share has been covering those dividends quite well. Okay, great. So now, I always try to emphasize, I don't like to just focus on the past. I like to look into the future. The past doesn't always predict the future, and for that sense, we need to really look at the most current data and then what people are also looking at for the future. Okay, great. So let's talk about, I love the Motley Fool. I think they're a fantastic source, and I really encourage you to check them out and compare both sides of the story. Usually they have authors who are very bullish and very bearish. And in this case, I was able to find someone who's bullish on General Mills and someone who's bearish on General Mills. So this is someone who was very bullish and says, this was after their last quarterly report, and says that General Mills finally sees growth in its future. They talked about zero organic growth, which is brutal, but the past year they seem to turn things around a little bit, and if they could continue on their trend, that would be huge. Revenue was up 2% to $3.9 billion, and operating profit was up 8% as its U.S. business began to rebound. Really, General Mills is looking into how price-sensitive customers are, so they're able to raise prices on some of their goods, and actually the customers responded quite well. The biggest concern, we talked about that acquisition of pet food earlier. However, that's not supposed to be a crazy source of growth. It'd be interesting if they were able to do that, but diversification is always nice, and I think it's an interesting and smart move. We'll see how it plays out in the long run. And then just more positive signs of growth. Management has better guidance for net sales growth, and organic growth is supposed to be 0. So it's not the end of the world. Interesting acquisition, and growth might be coming back soon. However, this article by the same website at Motley Fool says there's one really important reason to be bearish on General Mills, and that is because of basically rising costs of goods. General Mills really depends on low oil prices, and really their freight, when they're shipping some of their products via sea, that is just destroying their overall gross margin. Oil has really been taking a hit on them. This has been talking about how their revenue has been declining, and they in general have a lower gross profit margin than other competitors. However, let's look at some of the analyst ratings. Basically, analysts aren't crazy about this stock, but many, just because it's so cheap right now, very few are saying sell or underperform. Most people are at least hold or buy, and then some decent expectations. The median is about staying flat, just because there's concerns over revenue and growth overall. So to get into the conclusion, well, first let's look at the most important metrics that we have. Year-over-year net income growth has been okay. However, revenue and EBITDA growth has not been good at all. Their current PE ratio is literally fantastic. I love their current dividend yield. I love their dividend growth rate. Dividend payout ratio is a little bit high, and then there's a decent amount of space between now and when they run out of room for paying out dividends. So overall, would I buy this company today? Surprisingly, the answer is no, and now there's two main reasons. So first of all, I'm concerned about their potential for growth. Revenue has been plateauing and EBITDA has been plateauing. To me, you need to see increasing trends in that, or at least hope for that in the near future. And for both of those aspects to be plateauing, it is really concerning to me. Now, what's interesting is they've been able to increase profitability during that time, which is huge. And then furthermore, they have a great dividend yield right now. They have a great dividend growth rate. They have a nice payout ratio and plenty of time to grow that dividend. Therefore, I would only really consider investing in this company if they showed incredible signs of potential to grow again with regards to revenue and overall profitability. In order for me to see that, I would really have to see them create some sort of different sales strategy, or I'd need to see them really innovating and just killing it with that acquisition for pet foods. Overall, it's still not a buy for me, like I said, because of plateauing revenue and plateauing EBITDA. However, if they're going to turn that around, and if I saw signs of them turning that around, that would scream a huge buy for me, just because they're growing their dividend very nicely. They have a great payout ratio, and I just like their business overall. And quickly, like I said, so if we took their starting yield of 4.15%, used their 5-year average dividend growth rate, and invested $15,000 per year, we would eventually hit $65,000 a year in passive income just through dividends. And then if we just chilled for 10 years and didn't pay and reinvest those dividends, we'd start making $100,000 per year. So obviously, this goes to show that if General Mills could turn things around and restore revenue and restore profitability growth, this would be such a good time to enter the stock. But because of that one huge question mark, I need a little bit more time to really understand their new sales strategy. Can they innovate with this new acquisition? And for me, their super low PE right now isn't really the make or break. It's going to be revenue and EBITDA growth. That is a story you need to take away from General Mills. Thank you so much for watching this whole video. I hope you learned a few things about General Mills stock. Make sure to like, comment, and subscribe if you haven't already. And make sure to comment what companies you want me to talk about in the future. And if you have any feedback overall for this video, I would love to hear it. Thank you so much for watching again, and I'll see you all in the next video.